Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email update from me telling you about it. Now, if you're not on my free stock trading email list, you should get on it. Just scroll below this video to do it. Then you'll get every morning before the opening bell my commentary and links to the most important stories of the day that you need to know about. Now, this week was a fascinating week for the markets and sets the stage now for what we should expect to come. And I'll be talking about that. But last week, we saw the Federal Reserve raise interest rates by a quarter of a point. And the market soared on that news. The NASDAQ actually broke out. Gold took off too. One of the biggest one-day gains in gold in quite a long time. Stocks in the semiconductor space fueled the NASDAQ higher. That buying started to falter, though, by the end of the week. And Friday saw a plunge in the price of gold. Stocks also got hit. So what is going on? First of all, let's step back a second and think about the macro news that also played out, because we saw the Meta company, Amazon, Apple, and Google all report earnings disasters. Now, the Meta stock actually went up after it reported its earnings disaster. It reported that revenue had greatly it had continued to decline, costs continue to accelerate. However, they also pledged to take measures to focus on the cost cutting. They didn't speak about metaverse, and they did an announcement of a $50 billion share buyback. That helped push the stock up, and a lot of shorts got caught scrambling. Now, Apple also reported a complete earnings debacle, the biggest decline in revenue for Apple in 10 years. The sale of these Apple phones has declined. Look, inflation is biting people, and they have to adjust their spending habits. So spending $1,000 for a phone when you can get one for $50 or even cheaper, some people are choosing to not do that anymore. Let's forget about the Apple phone. Do you need a fad Apple Watch to be cool? Most people say no, and even more are saying no. So revenue declined for Apple, but the Apple stock gapped down on the news and then recovered and actually went green on Friday. Amazon also reported that earnings shrank, revenue shrank. However, that revenue news has happened after the massive online spending boom of 2020 and 2021 and the first part of 2022. So that was not going to continue to grow at that rate. And then Google also announced a reduction in advertising revenue. Again, same sort of trend. People are not going to be spending as much time online in 2023 as they did in 2020 in the first part of 2021. And that's good. So these gyrations in the popular big cap technology stocks do not really reflect what else is going on in the economy. So we found out on Friday that there was 500,000 jobs created in January. And this announcement surprised the economists, who are estimating about 200,000. It shows that the U.S. economy is not in a recession now and is actually stronger than most people had been anticipating so far this year. This is not a giant shock, because think about what we've been talking about when it comes to Europe. A year ago, people were saying that the European economy was going to almost be in the dark ages because of the war in Russia and the rise of energy prices. Now, what happened? The European stock market exploded in October and in November and continued to go up at a faster pace than the US stock market. It left it in the dust. Gold, silver, material stocks, stocks linked to global economic growth, things happening in the real economy took off that helped fuel the internals of the US stock market higher. More stocks were going up than would be simply evident from looking at the S&P 500 and the NASDAQ. We took note of that. And last week, the NASDAQ broke out, following all the previous breakouts that had happened in weeks, and in the case of Europe and gold, months in the past. The NASDAQ simply, followed suit. And so last week was a continuation of the rally that had really a broad-based rally all over the world that really began at the end of October, early November. And I don't think this move is over, in the sense that we're not in the type of market environment we were in last year, which was a bear market year. But we're now at a situation, though, where all these markets are pretty much overbought on a short-term basis. Now, that's the real reason, I believe, that we saw, for example, the price of gold take a hit last week. On Friday, gold fell $54 an ounce. That also followed a sharp decline for gold on Thursday after it had a big gap up, after this Federal Reserve meeting day. But look what gold did before those two declines. Gold fell down to $16.25 in October, made a double bottom in November, and then took off. And that takeoff you see in November happened simultaneously with the global rally that began all over the world. That the S&P and the NASDAQ lagged and then started to catch up and broke out the last few weeks. But what happened was, if you look at this chart, you can see there is a pullback in November from down to 1725 or so. But since that November pullback, there hasn't been a pullback at all of more than really one day, until finally a pullback happened now. So we went from 1625 an ounce in gold, tapping on 1975 Thursday, and now we're pulling back. So an over $200 price rise in the ounce of gold over almost 2.5 months without a pullback. Finally, we got a pullback. And notice the indicator at the top of this chart. That is the RSI oscillator indicator. It is a technical indicator that generates overbought and oversold readings. It crossed above 70 like 2 weeks ago. It's been above 70. That's an overbought level. And so you get pullbacks. That doesn't mean this is going down to 1625. It's likely to go sideways now over the next couple of weeks to work off this overbought condition. We could see gold go down to 1850. That's where its 50-day moving average is, roughly. Perhaps down to the 1800 to 1825 zone would not be shocking. So that's where we're at when it comes to gold. And then, in other words, a trading range after a bottom is established, probably this coming week. And then, that range can last for all month. We'll see. But this is also the story with markets all over the world. If we look at, for example, the German stock exchange, the DAX, it also had a tremendous rally starting in November. Once it loads up, you'll be able to see what I'm talking about. Here we go. And October, the rally started. And look, 1,200 all the way up to 15, or 12,000 all the way up to 15,500 is a tremendous rally. And it broke through the 200-day moving average in November. RSI screamed overbought in November. And what did it do? It didn't crash. The DAX dipped from 14,500 down and touched the 50-day moving average. This is the sort of move I think we're looking for in gold to continue to play out. I think the drop Thursday, Friday we can hit that 50-day moving average this week. And then you can see the DAX went sideways and then surged again, broke through in January. Its December highs, made a even new higher last week. This is a bull market right here. But I want to emphasize, it broke the turn-day moving average in November. And no really giant pullbacks, just pauses is what we're seeing. But remember, the breakout happened above the turn-day moving average in November. If we could draw these trend lines, all the way back to January, the breakout of that trend line was in November. With the S&P 500, that breakout of the trend line took place 2 weeks ago. That's when it broke through the turn-day moving average, and it continued higher last week to break away from that and to finally close above the December high. Even with Friday's dip of roughly 1%, we're still above the November high. So I think, but you can see RSI, tapped on that 70 level. So, the bias is to the upside of the U.S. stock market at, the trend sideways to up, not sideways to down, sideways to up. That's the kind of market we're in. And I think if gold, took that pullback that we saw, I think that suggests that all global markets, including the U.S. stock market, could pause here to digest the recent rally since October that we've seen. Not a big crash, but a simple pause. I think that's the most likely thing we're going to see play out next week. And that pause could go on for more than a simple week. It could even go on all month. So it's breather time for the financial markets. And it's not time to get scared about pullbacks. The trend sideways to up. But it's what you need to know is understand that we're not going straight up. Everything is overbought, and overbought conditions get worked off with quick pullbacks, sideways trading action. So that's what I think we should be not shocked to see this week. Most of the earnings season is out, and a lot of the companies have had bad earnings. There's no denying that. More stocks have had to lower their earnings estimates than rise them than quarters past. And the stock market has been resilient and shaken that all off. The bad earnings quarter that people expected has materialized. Last week's, big earnings disappointments of Meta, Google, Amazon, Apple, demonstrate this. But the stock market has been resilient, and perhaps the fact that 500,000 jobs were created in January tells us why. And you have the Fed still in a position where it's towards the end of its rate hiking cycle. March, there's pretty much another rate hike baked in for March, and there's a chance of one more after that. But that's still not much, one or two. If you look at where we started in the rate hiking cycle, where we are at the end of the tunnel. And that's why the market has been rallying. The market rally around the world, including in gold and silver, began when it became clear that the Fed was going from 75-point rate hikes to 50. It got to 50 in December. Now we're at 25. And 25 is going to lead us to pause. And pause, I think, what happens after that is you have a really sweet spot time for at least several months for the global markets. And that's what we're rallying into. We're pausing now. I think the rally will continue after a pause of a couple of weeks. So that's where we are. I'm not selling. I'm holding what I got. And I own a lot of stocks that pay dividends. I do have some money in CDs, which give me yields now. You can do that now. You don't have to have CDs yielding 0.5%. This is not 2020. This is a different market environment. So if you like this video update, hit the like button so I'll know to make more. If you want to get the next one when I make it, hit the subscribe button on the YouTube and then hit the bell next to the subscribe button. YouTube will send you an alert as soon as that video is up. And I'll be talking with you later.